the big money who's been bringing in billions and billions a week in this stuff, I think they have bigger ideas and bigger plans for where silver is ultimately going to go. Let me say it one more time. The most powerful nation on the earth, the United States government, who really doesn't have much in the way of silver, who's importing billions of dollars a month, billions and billions and billions a week and month into COMEX and other areas that we probably don't even know about, including buying directly from local and artisanal mines, has classified silver as a critical mineral. What does that tell you about what the U.S. government sees in place or has in mind for silver?
Over the last several months, a pattern has emerged in the silver market that deserves close, unsentimental scrutiny. Consistent, unusually large flows of physical metal into trading centers, persistent strength in spot pricing despite repeated paper market pressure, and an elevated premium between spot and futures that is uncommon outside of crisis moments. Renowned bullion dealer Andy Schectman argues that these are not random market blips or temporary arbitrage plays. Instead, they are signals, perhaps even deliberate moves by deeply resourced actors, that point to a far more strategic view of silver's role than mainstream commentary has allowed. For the investor, the important takeaway is this: when participants with scale begin treating a commodity like a strategic asset, price dynamics follow liquidity realities, not narrative. Andy's core thesis is straightforward but provocative. Large, well-funded buyers, including, he suggests, United States agencies and highly sophisticated Wall Street players, have been effectively funneling very large sums into physical silver purchases, often routed through established exchange mechanisms, but ultimately intended to secure real metal rather than paper claims. If this is happening at the scale he describes, the implications are profound. The shift from paper reliance to physical accumulation changes the risk calculus for holders of both bullion and derivative exposures, and it upends some of the conventional assumptions about the fungibility of contracts across international vaults. It is worth emphasizing that this is not presented as speculation in the absence of observable market stress. The market has shown concrete symptoms: sharp spot volatility within short windows, repeated and aggressive attempts to suppress price spikes, extraordinarily wide spreads between location markets, and delivery behavior that looks like standing for metal instead of rolling contracts forward. Those facts sit behind the thesis and are why experienced participants are taking notice. For investors who demand evidence before acting, we will unpack the market mechanics and trace the logical connections between delivery strain, counterparty behavior, and price signals. In his latest interview, Andy discusses the fragile float reported in London vaults, the abnormal backwardation showing urgent demand for immediate delivery, the reclassification of silver as a critical mineral by government authorities, and the coordinated accumulation by major state and sovereign actors. If you value clear, data-oriented insight, please like the video and subscribe to the channel and turn on the notifications bell for more videos like this. We appreciate the support and hope you enjoy the video.
It's really very unusual. Really what is so unusual, Michelle, above many other things, is the resiliency that we see with the spot price. They will, like, for example, on Friday, if I'm not mistaken, it was Friday, they knocked it down hard, a couple of dollars, under 50 into the $49 range. And just like that, by Tuesday or Monday night, last night, it was at $53.30 spot price. Now, that would have been in Asia trading. And now they've knocked it down again today, trying to mitigate its rise. And today, right now, we are, where are we? We're right around 51.60 or so, climbing back up. The strength that it is exhibiting in the face of continued attacks on it, a huge backwardation. Something I've never seen before, as much as a $3 spread between the spot market, the OTC market, and the December futures contract. This shows a massive stress in the system. Unprecedented strain, to your point. It is unprecedented. And it's not just volatility, Michelle. It's kind of, to me, it's the market exposing the shortage of physical silver and the fragility of the paper promises. I think this is something that is far more than just a one-off. It's something I've never seen before. First of all, what it tells me is more than anything is that buyers aren't just rolling contracts over the way they used to. They're standing for delivery. They're demanding the real metal. And to me, the takeaway is that the rush for physical gold and silver is real, and it's intensifying. And markets just aren't trading paper contracts any longer. They want metal in hand. Now, this is multiplied by delivery stream. You and I have talked at length since November. We've seen a continual influx of metal coming into the COMEX market. And you can blame it on tariffs or blame it on arbitrage or blame it on whatever you want. I don't believe any of that. I think this is much deeper. There are people that want us to believe it's not as deep. Even the Bloomberg article that says that there are ships that are being loaded up to send silver over to London. I don't believe that at all. As a matter of fact, I think that's spin doctoring, kind of to buy some time for the LBMA. If silver was so plentiful, they wouldn't need a PR scheme to tell us about the silver that's heading over there. I don't believe it at all. But when you talk about exacerbating what's happening, we've already seen almost 17 million ounces of silver delivered into COMEX in the month of October. And when you see a London spot silver price at a $3 premium to the New York futures, a spread that hasn't been seen maybe ever, at least since the Hunt brothers in 1980, at a borrowing cost in London that has spiked to 100% annualized, worse than the 1980 panic. What this tells us is that the demand for physical silver at the highest level. We've talked about the central banks buying it. We've talked about China buying it and flying around the world and buying doré and concentrate. We've talked about Russia and their really massive acquisition of silver over the last 5-6 years. We've talked a lot about Saudi Arabia and their fund, who just bought a few $100 million worth of SLV. And that sucks in and of itself that it was SLV. But remember, at the level they paid or bought, they can stand for delivery. We've talked about Russia adding it to their strategic stockpile. And lo and behold, we find the United States, the U.S. government, who wouldn't know a silver coin if it fell on their foot, it seemed all of these years, have now reclassified silver as a critical mineral. They have put a floor under the price of silver. So when you put all of this together and then add into it the most sophisticated traders on Wall Street, bringing metal in at the levels that they are, that is what is driving this. And in an environment where the LBMA, according to David Jensen, someone that you need to get on our show, David Jensen is amazing. And no one talks about the LBMA backdrop the way David does. And I think it's really very important we get him on. But what he's been saying lately is that there's 140 million ounce float of silver in London, meaning that's the amount of silver backing the contracts. The other silver they have there, the other 500 million or so ounces belong to the ETFs. So the only metal that is available, supposedly unencumbered, and who knows how much of it is unencumbered, when they already told us last year that they overstated those numbers by 100 million ounces at the LBMA. But if we take them at their face value, 140 million ounces, according to David Jensen, trading 600 million ounces a day in deliverable contracts. What could possibly go wrong? We have an environment where the exchanges and the paper promises are being usurped and passed on, even at large premiums right now, where if you sent your metal, if you bought a contract on futures and sent it to London at a $3 spread, that's a big arbitrage. And there will be some players that do that. But I don't think the smart money, even at a $3 per ounce premium to send it to London, really wants to do that, because silver is becoming far more valuable than the currency that is used to buy it or to sell it. If the shorts can't deliver, Michelle, the paper game ends immediately and silver explodes higher. The day a short cannot deliver is the day that silver breaks free. No delivery, no trust. That's when silver goes vertical. And if COMEX or the LBMA fails to deliver, it's not a dip, it's a liftoff for silver. And the whole system is based upon promises to deliver. And if you can't deliver, it's the same thing as a force majeure or a default. And the whole system, which is systemically connected, the contagion that would come out of that would be extraordinary. And that is the million-dollar question, and where things get really bullish for silver. So yeah, could it happen? It's never been closer to, by all appearances, to happening, and more so in London than in the COMEX.
To that end, we've got reports that metal is being airshipped between vaults from the US to the UK just to plug the gaps. What does that tell you about where we are in the cycle here?
Yeah, I don't believe it. I mean, I think some of it is, yes. I think that there is some metal that is moving that way. But I think that that's more a PR campaign. I think that, yes, there's always going to be some commercial bank arbitrage that we're seeing right now where they're able to, by sending it to London, capitalize on that spread. But I don't think that's really what is happening, to be honest with you. I think that is a PR campaign by Reuters and by Bloomberg to kind of say, hey, everything is okay. That metal, look, there is not a chance in hell that the metal can move over there fast enough to meet these demands. You're going to see lots of margin calls and unwinding of positions. And I think that it's just like they told us that silver was coming back here because of tariffs and arbitrage. I don't believe it. I think there is something much bigger at play here. And when the U.S. government reclassifies silver as a critical mineral, they're not going to be in a rush to send it over there to capitalize on some arbitrage. Yeah, you're talking millions of dollars. So what? I mean, I don't mean to say it in a cavalier manner that way, but I think the big noise about sending silver to London isn't strength. It's a cover story to calm nerves.
Andy strongly believes that the high-profile stories about metal being airshipped to London are, at least in part, a public relations narrative intended to reassure markets. If exchanges and custodians can paint the picture of movement and replenishment, lenders and counterparties are less likely to call margin in a destabilizing way. The reason markets need calming is not merely optics, it is the arithmetic of physical availability. When inventories that underpin paper contracts shrink relative to the volume of outstanding deliverable claims, the mechanical ability of short holders to meet delivery obligations erodes. That erosion shows up as backwardation, spiking borrowing costs, and concentrated deliveries that remove metal from the exchange's day-to-day float, all of which tighten the physical chain and raise the effective scarcity premium buyers must pay to obtain immediate metal. Put bluntly, if London and New York cannot demonstrate that deliverable metal exists in the quantities advertised, the market faces a confidence event. Paper contracts cease to function as promises and become litigated liabilities, and price discovery reverts to whoever holds real metal. However, the real question is how long they can keep the dam from bursting. By Andy's estimates, not very long. Next, we shift to the international dimension Andy stresses. China and other large buyers have been quietly disintermediating traditional channels, sourcing doré and concentrates directly and building vault capacity globally, a methodical accumulation strategy that exacerbates Western paper market stress while simultaneously increasing real-world inventories in carefully chosen jurisdictions.
Are there really ever coincidences anymore at these levels? You know, the United States certainly is a very, very powerful, great country, but many of the nations whom are rallying against us using commodities as a sidestep to the dollar and the treasury market hegemony, they have a say in all this too. And to your point, the Shanghai Metals Exchange, as you and I have talked about on many occasions, is not only trying to gain credibility and have other countries store their metal with them. Remember, they're in the process of building multi-jurisdictional vaults all around the world, starting first in Hong Kong, now in Saudi Arabia, and then ultimately through the Belt Road. Now, China, the second largest producer of silver in the world, David Morgan will tell you when he went to China, they tried to tell him they were number one. So number one or number two, number one in gold, yet they're flying all around the country, buying all around the world, Latin America, Peru, and Mexico primarily, buying doré, which are crudely refined bars, and concentrate, the byproduct of the mining process, directly from these players, disintermediating the market, right from the miners, disintermediating the market, and sending it all the way back to China on their expense, paying double what the West will to refine it themselves. These metals are becoming very critical to them. So yeah, why wouldn't they want this to happen, to allow the price to go much higher? And how do they do that? The same way I've been saying this since the first interview you and I did together years ago. They're draining the exchanges slowly and methodically. They're standing for delivery in London. The London Metals Exchange has the lowest amount of silver, the float, they've ever had in the 140-year history of the exchange, at least since they started keeping records. And so they have been using the idiocy of the Western suppression system to beat us at our own game. The part that most analysts and most naysayers have a hard time justifying when we say this is that they haven't done it like that. Everyone in this country expects instant gratification, and if it's not fast enough, if it's not immediate, it ain't fast enough. That's their genius. Slowly enough to not rattle the bushes. But they've done a yeoman's job at that. Look at the countries involved: Saudi Arabia, Russia, China, India. They're all accumulating silver in their own way as fast as they can, but also gold. Not too fast. And many of the other nations are too. So, yes, this would indeed. And the mistake that we make in this country is thinking that we are omnipotent and we have the ability to control everything. And you know what? As I've said with you before, these countries are now sophisticated, coordinated, motivated, and they have a plan that is methodical, a plan that drives the analysts in the West nuts because it's not in your face bang. No, but take a step back. It's just like the title of my show: little by little by little by little by little, and then bang, all at once. And we haven't seen the all at once moment, but is this the beginning of it? Maybe, could be, don't know. But absolutely, to your point, this would benefit not just China, but all of the BRICS nations. To say they have a hand in all of this and to poo-poo it and say no way is as naive as a mud wall. It's absolutely, I think, very plausible that the Chinese have not only interest in seeing this, but are understanding that their actions and slowly exacerbating it ultimately is to their best interest.
Is there a way that China could physically help engineer the squeeze?
Yeah, by standing for delivery all around the world. And that's what they've been doing. I believe that they have been involved in shorting the paper price as well, because if you can't beat them, join them. And then going all around the globe in places like London, in places like Shanghai, all around the globe, including the miners directly, disintermediating the marketplace and pulling silver inexpensively at a subsidized price because of the futures leverage, because of the suppression, and buying as much as they can, anything that's not nailed down all around the globe from centers that do not trigger price discovery. It's the COMEX that triggers price discovery. And so they're using the suppression of the Western paper market and probably adding on to it in an effort to do exactly what we're talking about. Slowly, instead of suppressing the market for other gains, political or militarily or whatever it may be, dollar supremacy, bond market supremacy, pick your poison. They're doing it because they realize we are entering a period of time where commodities will define the strength and legitimacy of a nation. And those commodities are not just going to be gold and silver and platinum. Platinum's another example where the head of the TOCOM, Bruce Ikamoto, or I'm butchering his last name, but Bruce, the head of the Japanese TOCOM, says they're trading over 3 million ounces of platinum a day in London, but in, as he says, local, meaning location, London and Switzerland, 0 ounces available. What could possibly go wrong if you're trading 3 million ounces of deliverable spot contracts a day against nothing? And the same thing is true in London. What could possibly go wrong when you have 140 million ounces with 2 billion ounces in contracts out there that could stand for delivery, not to mention the 600 million you're trading per day? What could go wrong? The Chinese have slowly played this game and buying it all around the world, including London, and they're achieving it by using our stupidity, our hubris, our suppression against us. Now, there will be some metal that will go back to London. There are a lot of players in that market, and some don't see the big picture. Some want to capitalize on the arbitrage. To the extent of what you're reading in Bloomberg, there is some truth to it. But on a big level, I don't think you'll see more than 5 or 10% of the metal that's shot back here go over there. And it will just be a few players trying to arbitrage the big money who's been bringing in billions and billions a week in this stuff. I think they have bigger ideas and bigger plans for where silver is ultimately going to go. Let me say it one more time. The most powerful nation on the earth, the United States government, who really doesn't have much in the way of silver, who's importing billions of dollars a month, billions and billions and billions a week and month into COMEX and other areas that we probably don't even know about, including buying directly from local and artisanal mines, has classified silver as a critical mineral. What does that tell you about what the U.S. government sees in place or has in mind for silver? These are the crumbs that a lot of people will just blow right past and ignore. To me, if you are a country who classifies an asset as a critical mineral, you're not going to let it all ship away. And so the majority of the metal that's come in under the guise and BS to that of tariffs and arbitrage, I believe has twofold implications. One, I think it was brought back to cover the short positions of many of the U.S. banks who are short in New York and long in London. They brought back their London metal to cover their shorts. And if I had to guess, had a gun to my head, I would say they've worked out a deal to deliver that to the U.S. Treasury under the guise of the Exchange Stabilization Fund to help build a stockpile of critical minerals and elements.
Having heard Andy's observations, the first corrective most investors should make is to mentally separate paper liquidity from physical liquidity. The former can appear ample on a spreadsheet, while the latter is concentrated, encumbered, or simply not available for immediate transfer. Paper contracts are promises and depend on counterparty performance. Physical metal requires logistics, custody, and, crucially, the willingness of owners to part with it. When a large fraction of available metal is effectively hoarded, whether by sovereigns, ETFs that stand for delivery, or strategic stockpiles, the margin of safety for anyone relying on paper substitution narrows quickly. Second, backwardation is not merely a pricing oddity to be ignored. It is an actionable indicator that immediate demand outstrips future supply expectations. For traders and allocators, a persistent spot premium suggests that carrying a position in physical, allocated metal may offer a real yield in terms of delivery certainty and insurance against counterparty failure. That is particularly relevant if, as Andy points out, institutional players are buying with the explicit intent of standing for delivery. The market impact of those decisions compounds with each cycle of delivery and reduces the float that underpins paper markets. Third, the international coordination Andy describes, China, Russia, Saudi Arabia, and other large buyers quietly accumulating across jurisdictions, alters the geopolitical dimension of commodity ownership. When nations treat a metal as strategically important, they are prepared to prioritize domestic stockpiling and controlled allocation over short-term arbitrage. That behavior can disconnect local spot markets from global paper indicators and create regionalized scarcity, which raises both the price level and the volatility profile. Investors must therefore evaluate exposure across custodial locations and vehicle types. Allocated bullion stored under tight legal title will behave differently from an ETF share or a futures contract. Finally, for investors considering tactical or strategic reallocation, the practical response should be graduated and evidence-driven. Validate the custody arrangements behind your exposure, quantify the deliverable float versus outstanding claims where possible, and consider increasing allocation to forms of ownership that guarantee physical possession if your objective is to hedge systemic counterparty risk. Do not treat silver as a purely speculative tape-reading trade. Treat it as an element of portfolio insurance whose value is rising precisely because the architecture of trust, paper versus physical, is being questioned. If you found this analysis useful, please like and subscribe. We bring you evidence-based breakdowns like this for investors who want to think beyond headlines and understand the structural mechanics that drive returns and risks. Thanks for watching.